Noon and welcome to the IFO's mid-year revenue update for fiscal year 24-25. My name is Matt Niddle, and I'm Director of the Independent Fiscal Office. Before we begin, the normal notes. The presentation will run about 20 minutes. If you have questions, please submit them to the IFO contact box, and we'll try to answer them today. We'll try to get back to you as soon as we can. At the end of the presentation, we will also post the PowerPoint to the IFO website. And if we happen to lose the connection, please hold tight and we will try to reestablish it as soon as we can. And then we will finish the presentation. So with that, we'd like to start out with our economic forecasts, and the forecasts are what we use to project revenues. And as we do every year, we show two forecasts. We have the forecast that we used last June for our official revenue estimate. And then we have the latest forecast for January of 2025. And we have them for our four main economic variables. And I'll just move top to bottom and point out a few items that we're seeing in the data. For real gross domestic product for Pennsylvania, we had stronger growth in 2024. We revised it up to 2.2%. And for next year, we're at 1.4%. For wage and salary growth, we were at 4.1%, and we've revised that up to 4.8% in 2024. So we're going to pick up some monies due to that. For 2025, we've revised the forecast up from 3.9 to 4.2. Our annual job gains, we had them at 40,000 last year, and we're revising them up to 70,000 year over year. And for next year, a gain of 40,000 jobs. And finally, for the Philadelphia Consumer Price Index, we had projected 3.5%, and it came in at 3.6%. For next year, we are projecting 2.8%. So still a bit elevated above the Federal Reserve's target rate of 2%. On the next slide, we move to some economic trends for the latest 4 quarters of data that we have. And starting at the top, we have what we consider the best real-time indicator of the Pennsylvania labor market, and that's our withholding tax revenues. And these are year-over-year growth rates. And you can see that they're growing at about the mid-4, 4.7, 4.6, 4.5. And then in the fourth quarter, we had a nice bump here at 5.5%. And this, we think, is due to end-of-the-year bonus payments. The next item is the Consumer Price Index for Philadelphia, and you can see it's decelerating, the latest reading at 3.3% in the fourth quarter. For consumers, the best real-time indicator of consumer health is our sales tax revenues. The first one is for non-motor vehicle sales tax, and that was decelerating, the latest reading at 2.6% year over year in the fourth quarter. Below that, we have motor vehicle sales tax. Last fiscal year, it was contracting. It has now turned positive, and the latest reading is 1.5% year over year. The final variable for consumers is credit card debt. It was growing at double-digit rates at 10% and then 9%, and the latest reading is 4.5% year over year credit card growth. Our final numbers are for the Pennsylvania labor market, and the unemployment rate remains historically low. The latest reading is for 3.5% in the fourth quarter. Below that, we have our 2 job measures. The first one is payroll jobs, and this excludes self-employed individuals. And here we have a year-over-year gain of 91,000 in the fourth quarter. Our second measure is employment. This is from the household survey, and this includes self-employed individuals. And here we have a different story. We have a contraction of 20,000. And I'll say a bit more about this 2 slides from now, but just noting the discrepancy between these 2 jobs figures. But first, I would like to say a few words about inflation. And the black line is the all items inflation rate for Philadelphia. And the latest rate is 3.3% year over year. That's a bit higher than the US, which was at 2.9% for December. What's driving inflation in the Commonwealth really is the shelter component, which is 38% of the total. The latest reading for shelter is 4.8% year over year, and that includes both homeowners and renters. If we were to look just at renters, the rate would even be higher. It would be 5.5% year over year growth in rental payments. Also very strong, not surprisingly, is car repairs and insurance. Year over year, it was up 11.2% in Pennsylvania. Groceries here is 10% of the total. They are moderating down at 2.3% year over year. And finally, we have some deflation down here in our energy component, which is 6% of the total. And we also have deflation in home furniture and furnishings, which were down by 2.2%. Well, returning to the jobs measures, we have two graphs here. The first one is the seasonally adjusted data. And these are the data that you'll typically see published by the Department of Labor or the Bureau of Labor and Industry. And the blue line is our employment measure. And once again, this includes self-employed individuals. And below that, we have payroll jobs, which excludes self-employed individuals. And we have the trends over the last 5 years, since before COVID to the latest quarter, the fourth quarter of 2024. Over that time period, employment appears to have decreased by 8,000, while payroll jobs appears to have increased by 120,000. And you'll see more recently, we have the discrepancy between the two numbers, that one is growing and one is contracting. Down below, we have the non-seasonally adjusted data, and I prefer these data because we've had some difficulties with the seasonal adjustment factor due to COVID. So this is kind of a cleaner read, and you'll see that the line here is a bit more jagged. But if we use a non-seasonally adjusted data, you'll see that there's a very large discrepancy here at the end. And using the blue line, it appears we've lost 98,000 jobs over this 5 years. But the red line suggests we gained 112,000. So we're really not sure what's driving this discrepancy right now. It could be less self-employed individuals. It could be more multiple job holders. The employment measure, if you have more than one job, you're only counted once, but the red line, you're counted twice. And we're not sure what's driving it. What I suspect will happen is the red line will be revised down in the spring. What we do know, this last bullet point, is our withholding tax revenues are holding up very well. So we don't think the labor market's contracting, despite what these measures are saying. We do think it remains healthy, and we've assumed that going forward. I'd like to say a bit about the Pennsylvania home market, and in particular, residential mortgages. And here we have the latest data from the FHFA for the latest 6 years for the third quarter. And we do think there's a bit of a headwind here with residential mortgages and the amount that folks are paying, especially for new mortgages. And let me walk you through what the data look like. So in the first column, we have the number of loans of residential mortgages. And you can see recently, it's actually contracted. These are in thousands, so about 1.9 million, but it actually fell in the third quarter of 2024. The average monthly payment over this 5-year span has come up 25%, and this includes both homeowner insurance and taxes. In the next column, we have the average mortgage rate, and you can see it came down to 4% in 2022 and has come up since then. The reason it came down is the rate on new mortgages bottomed out in 2021 at 2.9%. However, you can see how rapidly it's come up from that point and is currently at 7%. The average loan to value ratio has come down a lot because home prices have appreciated. It was at 57%. It's now down at 47%, 10 percentage points. And finally, the average loan age, and this is in months. So it bottomed out at 68 months in 2022, but you can see how rapidly it's come up since that point to 78 months, just 2 years later. So the headwinds here, they're really threefold. One is the average monthly payment is up dramatically, 25%. The second part is that the rates for new mortgages are going up as well, and we think they'll stay above 7%. And finally, the average age of these loans is increasing as well. So all three negatives. And of course, this takes money out of the Pennsylvania economy and what consumers can spend. Our final economic slide, we take a look at the financials and the stock market and interest rates. And at the very top, we have the year-over-year increase in Pennsylvania home values. So it's doing very well earlier last year, 7-8% growth. The latest reading is 5.5% for the third quarter of last year. And let me note, these are for all existing homes, not just homes that are sold. Down below that, we have some data for checking accounts, the balances. We don't have data for Pennsylvania. It's for the US. But you can see at the end of 2023, it was actually contracting as the stimulus funds were spent down. Since that time, it's come up to about 2.5% growth year over year, which is a solid number. The S&P 500 index, very strong growth, 25, 27%. And the latest reading as of yesterday was 23% growth year over year. I'll return to this later. We think we're going to get a kick in our capital gains tax revenues in April. The 10-year Treasury, it's currently at 4.5%. We think this is going to go up closer to 5% next year due to the federal deficit. And closely tied to that is the 30-year mortgage, currently at 7%. And we also think this will remain above 7% also due to pressures at the federal level and federal deficits. Turning to the second half of our presentation, we look at the revenues through January. And through January, we think we'll collect $24.13 billion. The IFO estimate last June was $24.03 billion for a differential of 101 million. Compared to last year, that's an increase of 377 million and a growth rate of 1.6%. The places we're picking up monies relative to our estimate is in corporate net income. We're picking up $47 million through January. And also down here in withholding, we're picking up 84 million due to stronger wage growth. Here in the final column, we have the year-over-year growth rates. Of course, corporate net income tax is negative. This is due to the ongoing rate reduction. And then down below, the other story is the contraction in interest that is accruing on the general fund surplus balance, what we call treasury interest. It was down $100 million from last year, a contraction of 20%. Turning to our mid-year revenue update for fiscal year 24-25, our original estimate was $45.77 billion. We're increasing that to $46.05 billion, an increase of 279 million, and a growth rate of 1.3%. Now, on the prior slide, you'll see that we picked up $100 million through January, and we're increasing our estimate by 280. So we still have about $180 million yet to pick up through the rest of the fiscal year, through the 5 months. And there are 2 places we're going to pick those monies up, we think. The first one down here is in personal income tax, other, this $114 million. Again, we think that's going to be due to strong capital gains that we'll start seeing in March and April in the final payments. And the other item is down here in the all other category. We're adding 52 million, and that's due to an increase in $35 million in bank shares due to stock market prices. This is a spot price tax on January 1. And we're also adding $30 million to our gross receipts tax estimate due to higher than anticipated electricity prices. To take a look at our largest 2 revenue sources, which would be withholding and sales tax revenues, and combined, these 2 comprise about 63% of all tax revenues. And as I noted earlier, they're really the best real-time indicators of the overall health of the Pennsylvania economy. And you can see for both of these taxes, a few years back, we had a nice bump from COVID. Since that time, they have come down to more of a steady state growth rate. And for withholding, a normal growth rate is about 4%. That suggests a relatively robust labor market, and we're right about there. And for sales taxes, something between 2 and 2.5% is normal and would be expected. And you can see we're right about there as well. And we're projecting those growth rates to hold over the rest of the fiscal year. Turning to some of our mid-tier revenue sources, because they also tell a story about the Pennsylvania economy. We look at our realty transfer tax revenues, and these amounts are pre-transfer. But you can see last fiscal year, they were contracting largely due to the lock-in effect because folks did not want to sell their homes due to high mortgage rates. More recently, that's relaxed somewhat, and now we're getting a gain in our realty transfer tax revenues. It's positive. And I think that's due to a reduction in this lock-in effect as home buyers realize that interest rates are going to remain high, and so they're not delaying their purchases anymore. Our second mid-tier source, our cigarette tax revenues. This has had very strong contractions since COVID, double digits, very surprising. And you can see recently that contraction has continued. Don't have a good explanation for that as of yet. And finally, Treasury interest. This is interest that accrues on the general fund balance. And you can see last year we had very strong growth, 85%, 34%, as the balance accumulated. More recently, we've turned a corner and now the revenues are contracting due to the declining balance as the general fund surplus is used for deficit spending and also due to lower interest rates. On the next slide, we take a look at our updated general fund financial statement. And we show the latest 2 years of data. These are actuals. In 22, 23, you'll recall we had a general fund surplus of about $3 billion. For 23, 24, we had a deficit of $791 million. And then for 24, 25, we plug in the latest values for our revenues. We are projecting about $2 billion in refunds. They're running very strong yet again this year. We plug in the number from the executive budget, which will be modified here in a week. And if these figures hold up, it would suggest a fiscal year deficit of $3.4 billion. So that $3.4 billion is the same number that we published back in July. It's the same number we published again in November. Things haven't really changed much since then. The revenues are coming in as expected. If that number holds up, then the general fund ending balance at the end of this fiscal year would be about $3 billion. And as we projected before, due to the ongoing structural deficit, we are expecting that general fund surplus to be depleted next fiscal year. Turning to our preliminary projection for FY 25-26, we have a general fund estimate of $46.82 billion. That's an increase of $772 million and a growth rate of 1.7% compared to the prior year. Two items to call out. The first one is the corporate net income tax. We have a contraction of 6%. That's due to the ongoing rate reduction and the higher NOL thresholds. And then down below, once again, we have the contraction in Treasury interest of $283 million, about a 50% reduction due to the rapidly declining balance. If we were to remove these two items, Treasury interest and corporate net income, we would have a growth rate of 3.4%, which is a normal growth rate for a non-recession year. So to close out, a few factors that we did not take into consideration and some other notes. One thing that we did not take into consideration was the Tax Cuts and Jobs Act. Basically, we assumed full extension. Of course, we're not sure what will happen here. There could be some behavioral responses depending on the policy that is enacted, and there could be some payment shifting in and out of the fiscal year. On the federal spending, we are expecting significant cuts. Already, Medicaid spending has been come down dramatically. We haven't built any of this impact into our estimates at this time. When we revisit our estimate in May and June, we will try to build this in once we have more detail. For interest rates, as noted, we're assuming that the 10-year Treasury is going to climb to 5% due to the ongoing federal deficit. And if that holds, then we do think the 30-year mortgage will remain above 7%. And as noted, that's creating some headwinds for Pennsylvania consumers. And finally, for the stock market, you saw that there's very strong growth, and we're projecting a decent pop in our final payment in April due to capital gains realizations. We have assumed that the stock market would slow down, would decelerate somewhat, but we're not assuming any type of broad correction on the order of 15 to 20%. So with that, we'll conclude the presentations. And once again, if you have any questions, please submit them to the contact box, and we will try to get back to you today with an answer. Thank you for attending and have a great rest of the day.